All right, let's get right into it. Today, we're tearing down a headline that's pretty much impossible to ignore. A prediction that a single penny stock could shoot up by over 450%. How on earth does a story like that even happen? We're about to find out. Okay, just look at that. 458%. That is the potential gain in just 1 year that at least one Wall Street analyst is calling for. I mean, when you see a number that big, your first question has to be, where in the world did they get that from? And that's really the core mystery we're unpacking here. The company is Surf Air Mobility. Its ticker is SRFM. Now, it's what's known as a penny stock, which basically just means it trades for under $5 a share. In this case, it's sitting around $2. So, how does a $2 stock get a jaw-dropping prediction like this? To really understand that 458% number, we've got to peel back the layers of the headline. We need to see what the analysts are actually saying. Because trust me, it's almost never as simple as it looks on the surface. And this right here, this is where it gets really interesting. That incredible 458% gain, it comes from one single analyst's high-end price target of $12. But look at the average. It's way lower at $7.75. And one analyst thinks it's only worth about $3.50. This isn't a consensus, not even close. This is a fundamental, massive disagreement about what this company is even worth. So why is there such a huge gap between these predictions? Well, it all boils down to a pretty simple question that Wall Street just can't seem to agree on. What exactly is Surf Air Mobility?
And here it is, the central conflict laid bare. On one hand, if you see SRFM as just another regional airline, you're looking at a business with razor-thin profit margins and a slow, heavy growth model. But if you see it as a software-as-a-service company, a SaaS company, you see huge margins and absolutely explosive potential. The story you buy into determines whether this stock is worth $3 or $12.
So, let's start with the bull case, the argument for that massive 458% gain. This whole story is built on the company's ambitious plan to transform itself from an airline into a legitimate tech powerhouse. At the absolute heart of the bull case is this product, SurfOS. It's an AI-powered software platform that, and this is key, isn't even on the market yet. The big vision here is for SurfOS to become the essential operating system for the entire regional air travel industry, making everything from scheduling planes to managing maintenance way more efficient. And it's designed to be the whole package, a complete ecosystem. You've got Broker OS for handling sales, Operator OS for juggling all the complex logistics of planes and pilots, and Owner OS to help manage the actual aircraft. The idea is to be a one-stop shop that runs the entire industry.
But you gotta ask, does this thing actually work? Well, Surf Air has a pretty powerful case study right in their own house. They use their own SurfOS software on their charter business, and get this, they cut their expenses by 36% while their revenues went up. Now that is the kind of proof of concept that gets investors really excited.
You know, a great product isn't always enough to guarantee success. The bull case here gets truly compelling when you look at the company's competitive advantage, what investors like to call a strategic moat. And here it is. This is a huge deal. Surf Air Mobility signed a 5-year exclusive deal with the AI and data giant Palantir. This means SRFM is the only game in town for Palantir-powered software in the on-demand charter space. It's a massive stamp of approval for their tech, and it builds a pretty formidable wall around their business. Okay, so that's the exciting, high-growth dream. But now, we have to flip the coin over and look at the other side, the bear case. Well, it's not about what the company could be. It's about the cold, hard, and frankly, very challenging financial reality of today. First thing, let's look at the bottom line. Even though they've made some improvements in their airline business, the company still lost over $27 million in the last quarter alone. They are absolutely burning through cash. Second, look at this number, a gross profit margin of just under 6%. This screams low-margin, capital-heavy airline. It does not look like a high-growth, asset-light software company. This is the number that keeps the whole story grounded in a tough reality. And third, this is critical. Before they managed to secure a new $100 million financing deal, the company had just over $7 million in the bank. When you're losing nearly $10 million a quarter, you can see just how precarious that situation was. It really highlights how dependent they are on outside money just to keep the lights on. So this table really sums up the big red flags. First, share dilution. That new financing deal, it includes something called a convertible note, which is basically a loan that can turn into more shares later on. And when more shares get created, your piece of the pie gets smaller. Then there's that critical cash burn we just talked about, and maybe most importantly, massive execution risk. The entire bull case, that whole beautiful story, hinges on a perfect, on-time launch of SurfOS in 2026. Any kind of delay could be an absolute disaster.
So you're left with these two completely opposite narratives, right? A high-growth tech dream on one side and a cash-burning airline reality on the other. How do you make sense of that? Well, in the investing world, this is what's called an asymmetric bet. It just means the potential upside is way, way bigger than the potential downside. You could lose your initial investment, sure, but you could also gain many, many times that amount. It's a risk-reward profile that's really attractive to a certain type of investor.
This is basically the bull's roadmap to victory, and it shows you just how much has to go right. For SRFM to ever hit that $12 price target, every single one of these steps has to happen and happen in order. Launch SurfOS perfectly, get about $40 million in recurring software revenue, and then convince the entire market to forget the airline and value them like a tech company. It's a tall order.
So what this all boils down to is that this isn't some simple, safe investment. It's a highly speculative bet on a massive business transformation. It's a bet that this company can successfully pivot from being a struggling, low-margin airline to a dominant, high-margin tech company, all while fighting some pretty serious financial headwinds.
And when you really step back, this whole explainer isn't just about Surf Air mobility. It's about a pattern you see all the time in the market. Whenever you come across a sensational headline or a story that just seems too good to be true, it's always worth asking yourself, what is the real product being sold here? Is it the company's actual business today, or is it the dream of what that business could someday become?